Right, good afternoon, everybody, and welcome to Essentials. My name is Dale Franklin, and I'll be your host for today. Welcome to a more somber subject today, which is the ramifications of war. Clearly, it's a sad time where we lurch from the crisis of COVID into the crisis of Ukraine. There's been a lot of questions on this crisis. There's been even an uncertainty about how this started or why this has happened or when it's going to end. I don't know we have all of those answers, but certainly a fund manager that has done a great deal of research in this area is Peter Little. Peter Little has been with Anchor right from the early days, and he's following up a wonderful piece he wrote on the Ukraine crisis. So without further ado, I'm going to hand over to Peter Little.
Thanks, Dale. Thanks for the intro, and thanks to all of you who've taken the time to join us this afternoon. Hopefully, we'll be able to give you some decent insights into what's going on out there.
Pete, perhaps just one quick one. Sorry, I forgot to tell everyone. If there are questions, if people could please just post them into the chat function.
Excellent. Thanks, Dale. Yeah, so I have probably 20 odd slides that I want to take us through today. That should take me, call it 3/4 of an hour, and plenty of time for questions after that. We're heading into the afternoon, and most of your morning coffees will have been wearing off, so I'll try and keep it fairly lively. As Dale says, keep those questions coming to the end. So I must say, when these guys asked me to chat about the ramifications of war for a meeting that was scheduled for the end of March, and this was early in March, I was somewhat skeptical that we would still be laser focused on this topic, that we perhaps moved on to the next thing, and that hopefully the conflict had have died down a bit, but it's still very much front and center. So let me take you through kind of what we want to talk about this afternoon. I'm going to start just giving my perspective on the background to why we think this conflict is happening, and a little bit about the state of the actual conflict. And then I'm going to move pretty quickly on from there into the implications for the broader sort of global economic perspective and financial markets, and then the impact on investors around the world. But let's get cracking with a sort of a discussion on how we find ourselves at this point. And I've got 3 maps, courtesy of the BBC, on this slide here that you're seeing. The first one on the left is sort of a history. So starting in the late 40s, after the Second World War, at least, when NATO was formed, it was essentially European countries and the US that formed this military alliance to try and defend against any potential attacks from, at that point, the Soviet Union, which incorporated Russia and most of the Eastern Bloc states. And so it was very much a military alliance focused on the sort of Cold War fight between the Western Europe and the Western world and the Soviet Union. Initially, it had 12 members. And then sort of towards the late 80s and into the 90s, as the Soviet Union started to collapse and the communism was kind of breaking down there, we started to see the NATO alliance sort of losing its place and not really knowing what it was for at that stage. And interestingly enough, into the late 90s, a lot of those former Soviet countries started joining NATO, sort of moving to this Western aligned military alliance. And that's basically what this first map is on the left-hand side here. So the countries in dark blue are the original NATO members formed in the wake of the Second World War to prevent against the potential Soviet invasion. And then we had this slew of former Soviet and Eastern Bloc countries joining NATO from about 1997. So there's about 14 of these countries in this orange color here that are now NATO members that were formerly Soviet Eastern Bloc countries. So that's kind of how NATO had moved along. And as you can see from this map, Russia, which is the on the far right here, its western border is getting a whole lot closer to NATO over the course of the last 20 years. So NATO sort of stopped over here in these purple countries, and then as all these former Eastern Bloc countries started joining, the proximity of NATO countries to Russia got closer and closer. And so now where we are is essentially there's two countries, Belarus and Ukraine, which are left as the buffer between Russia and NATO countries. And then if we move on to this middle chart, where essentially what that means is this NATO military alliance includes having NATO troops, often US troops, physically based in your country. And so, we have US troops based in Poland and Romania, Bulgaria, Lithuania, all of which are relatively close to Russia, but for this buffer of Belarus and Ukraine. And so in around 2018, when Ukraine decided to change its constitution to give it the possibility of joining NATO, the prospect of Russia having NATO countries directly on its border and potentially even US troops directly on its western border was not a particularly appealing one. And as sort of Ukraine has moved closer to trying to join with NATO and even potentially become an EU member, this has become more and more uncomfortable for Russia. And so that's kind of the narrative that we have around this war is Russia said NATO's got close enough and I need this buffer between myself and NATO, and that's what started the conflict. So ironically, if Russia were to just consume Ukraine and say this is now our territory and Ukraine no longer exists, it would effectively end up with all of these NATO troops on its western border. So we doubt that that's what it wants to do. We think it just wants a Ukrainian regime that is less Western biased and more, at worst case, neutral, but best case, more biased towards Russia. And then just on the far right-hand side here, this is obviously sort of changing all the time, but this, the highlighted, so we've got the focus on Ukraine in this map, and the highlighted sort of red and stripy red areas, essentially where Russian troops have taken control of portions of Ukraine. And as you can see, they're largely focused right on the border of Russia. So Russia's western border, Ukraine's eastern border. It's taken a whole lot of control of a whole lot of regions there. And then also in the south, and these areas which border on the Black Sea, which is a fairly crucial logistical route in and out of those countries and the rest of Europe as well. So most of the Russian invasion is focused on these border areas. Obviously, there's been some conflict in Kiev, which is the seat of government. Recently, we've heard that Russia's stepping back from that. We're somewhat skeptical that that's a permanent arrangement, and more likely seems, at least from the reports we get from the brokers that focus in on this fairly intently, is that Russia just needs to kind of catch its breath and regroup before it can go back to that conflict. But for now, this is what the conflict's about, and this is kind of where it's been headed. So that's the background to the conflict. I'm going to switch tack fairly rapidly and talk about the economic and financial ramifications from this. And it's going to seem somewhat callous. Obviously, the humanitarian impact of this conflict is disastrous, right? There's families, the lives have been lost, families have been torn apart, people's homes and livelihoods have been destroyed. So this is a major humanitarian crisis. But today, the primary purpose of this website or this webinar is to try and look at the impact that this might have more broadly globally to investors. And so the first slide I want to talk on in that context is this is just a table which I've ranked by economic output by size. So you can see the US is the biggest global economy. It's about a quarter of all global economic activity. This is data from pre-COVID, so it wasn't skewed by any of the COVID sort of shifts. But about a quarter of global economic output comes from the US. Then you drop down to the EU at about just less than 20%. And then Russia is the 12th largest economy, but it's still only less than 2% of global economic output. So 1.8% of total global economic output comes from Russia. And then you drop all the way down to 50th position, where we find Ukraine at just 0.2% of global economic output. So combined, these regions, Russia and Ukraine, contribute about 2% to global economic activity. So even if we were to completely wipe out economic activity in this region, which is obviously not our base case, it would be not much more than a minor speed bump in the global perspective. Even if we focus on the next couple of columns, the population of Russia, just over 140 million people, less than 2% of the global population. Ukraine at just over 40 million people is 0.5% of global population. So again, in the context of the population globally, just over 2% of them sit in this region, so not particularly significant from that perspective. The one area where it is somewhat significant is in the landmass. So in the two columns to the far right-hand side, Russia is by far the biggest single country landmass in the world. It has about 12.5% of all landmass is in Russia, so about 1/8 of the entire global landmass is Russia. Ukraine on that basis is quite a bit smaller, so it's just less than 0.5% of the global land masses in Ukraine. Now, perhaps trying to put those numbers into context, this is not a fair fight by any stretch of the imagination. So if we look at Russia versus Ukraine, real David and Goliath story here, the Russian economy is about 10 times the size of the Ukrainian economy. It has about 3.5 times more people than Ukraine, and its land mass is about 30 times bigger than Ukraine. So it's really not a fair fight, this. And even just to try and put Ukraine into context, if we think about it in our South African terms, our own economy is more than twice the size of Ukraine's economy. Our population is about 30% bigger than Ukraine's. And just even in geographical terms, South Africa is more than twice the size of Ukraine. So Ukraine is pretty small in the greater context of the globe. What is probably slightly more concerning is the relationship between Russia and China. And so what I've got on this slide here is I've got that table again where we rank the global economies. And China is the third biggest global economy at about 17 or 18% of total economic output globally. So it's very significant in the global economic terms. Almost 20% of the world's population lives in China, and it's a fairly decent sized landmass. And why I bring this up here is because in early February, before the conflict happened, when China was hosting the Winter Olympics, there was a meeting, very public meeting, and a very public declaration after that meeting between Vladimir Putin of Russia and Xi Jinping of China, where they said that the friendship between Russia and China had no limits. And they expected to kind of enhance their partnership and work together to counter what they saw was a sort of US dominance of global geopolitical events. And so then fast forward a few weeks when the conflict happens, while as I say, this conflict is a humanitarian disaster for that region, and it has some economic implications, which we'll go into more detail on. What we were very much keeping an eye out for was how China responded to this. So to the extent that China gave Russia its full backing for this conflict and was happy to kind of get fully behind Russia, as it had said that their friendship had no limits, that would have potentially created a situation where Western governments now needed to extend their sanctions to China, and the economic ramifications for that are massive. And so far, China have been fairly mute on this. They haven't explicitly come out in support of Russia. They haven't explicitly come out against Russia on this. So they're sort of, we don't really know where they stand, but fortunately for now, they haven't come out strongly in support of Russia, which I think has which is great from a sort of broader geopolitical peace perspective, and certainly from an economic perspective. So that's kind of China lurking in the background of that. For now, we think that's a limited risk, but obviously something we're still keeping an eye on. And China, of course, have similar designs on Taiwan's sovereignty. So they're probably also looking fairly closely at what's happening with Russia's invasion of Ukraine and Russia's influence of Ukraine's sovereignty, and kind of thinking about how that might extrapolate to how they deal with Taiwan. So that's China. Now let's go back to the economic impact. So we started off by saying at a 30,000-foot view, the economic impact is fairly insignificant for these regions. But where they do punch above their weight and where the kind of ripple effects are most likely to be felt more broadly globally is in the commodity space. So as we said, Russia is about an eighth of the overall land mass of the world. And as such, it's a big producer of natural resources. And so this chart goes through the whole host of things that come out of Russia and their proportion of the total supply of or production of these commodities. And there's everything in there, from palladium at 40% of the world's palladium supply is coming out of Russia. There's 30% of the world's diamonds. You have energy commodities in there. You have all sorts of things, nickel, aluminium, silver, pretty much most of the significant commodities that are used in various manufacturing processes or consumed via the food chain come out of Russia. And this is where we'll focus in, or we'll hone in on how this might ripple out and affect the global economy more significantly. So starting off with, I'll just take a snapshot of what's happened to commodity prices, and particularly those commodities where Russia is a major supplier. So I've got two columns in this table on the left-hand side. The first is just taking the price movement of these various commodities since 20th of February, which was slightly before the start of this conflict, and then year to date. And year to date, I've put in there because, it's not like we all woke up on the 23rd of February to the fact that there was a conflict. There was a buildup. The US had been warning since December that troops were building up on Russia's border with Ukraine. So we knew that this was happening, and we were sort of starting to price in some implications. But obviously, the severity and suddenty of this conflict has largely been felt since the 20th of February. And as you can see there, we've got a lot of things that have had significant moves. Nickel, which about 6% of the world's supply of nickel comes out of China, and we've had a big squeeze in that commodity. It's up almost 50% over the course of the last month or so. It was up, 200-300% at some point. You've got things like natural gas, wheat, Brent crude oil, all up 20-30%. So we've seen some pretty big moves in commodity prices over a pretty short period of time. And that brings me to the slide, the picture I've got on the right-hand side of the slide of some random guy with a trolley full of toilet paper. And this is sort of, we're coming up for the 2-year anniversary of, or we've just passed the 2-year anniversary of when we all got locked down at the beginning of 2020. And most of you will remember there was a lot of uncertainty around that time. We were going to be locked away in our houses. You had a limited window of opportunity to go out and buy supplies before we bunkered down. And we can look at it, in hindsight with a fair degree of humor. But at the time, lots of us were scrambling to get as much toilet paper as we could. And that was a little strange, right? Because toilet paper is pretty readily available. You can get it in most shops. It's pretty easy to make. There's no real shortage of supply of toilet paper. But at the time, we didn't know what was going to happen. And the prospect of running out of toilet paper is obviously not a great one. And so rather than take your chances with the supply chains and the like, you just pay whatever price you need to pay to stock up on toilet paper. on the outside chance that you run out of toilet paper, or for some reason we can't ever make toilet paper again. And that's a little bit like what's gone on in the commodity markets now. So as I say, there's significant supply of these commodities coming out of Russia, and we'll talk a little bit about Ukraine as well in a couple of slides. But as of yet, there's been no significant disruption to moving those commodities out of the country. Sanctions are complicating things, but as we see, gas, oil, and various agricultural commodities are getting out of Russia, albeit with slightly higher logistical hurdles. But so far, there's no real prospect of just a complete shutdown of that source of commodities. But people aren't willing to take chances, and so we've seen huge stockpiling of metals and industrial commodities and various agricultural commodities, and that's obviously pushed the prices fairly dramatically. I'm going to focus on a couple of particular pockets of commodities, which I think will have the biggest chance of reverberating globally. And the first one is obviously oil, which we all need. Everyone in the world requires oil at some level to drive your vehicle, to run your factory, to keep the lights on. And Russia is a significant producer of oil. So globally, we produce somewhere around 100 million barrels of oil a day. And Russia produces about 12 million of those. So about 12% of oil output comes out of Russia. And so that's a fairly significant chunk. If that were to disappear, we would have a huge squeeze in oil. And so we've seen big movements in the oil price. Now, in theory, the United States, which produces about 17 million barrels of oil a day and is the biggest producer globally, they were producing about 20 million barrels pre-COVID. And a lot of that was coming from fracking and shale. And then we had this sort of increase in ESG investing and real concerns around the use of fossil fuels. And so there's been a big clampdown on investment in that. And as a result, we've seen about 3 million barrels a day of US shale oil come out of the market. Now, in theory, we could switch that back on to meet any shortage of supply as a result of the conflict. But in practice, it's slightly more complicated than that, because a lot of the providers of resources into the fracking industry have shut down because they were pushed out of business as we shifted away from fossil fuels. So, for example, you use a special kind of sand to blast into these rocks to get the shale gases out of there. And a lot of the producers of this sand have gone out of business. So previously, you could have a pretty quick response from the shale industry to ramping up oil supplies. Could be anything from 3 to 6 months. Now it's probably going to take a little bit longer. So the disruption could last slightly longer. Similarly, Saudi Arabia on about 12 million barrels a day, or somewhere between 11 and 12 million barrels a day. They can go up to 14 or 15 fairly easily. They're somewhat reluctant to do that because they're enjoying the higher price. But we could find ways to get this oil back, even in a worst case scenario where Russia were to completely lose access to global export markets. But I would say it's at worst case, you got 6 to 12 months of really probably tight markets, and then it eases after that. But the reality is this Russian oil is finding a home. Korea is buying a lot of it. We've heard today that India is negotiating for purchases of Russian oil, and they're selling their particular brand of oil, the Urals oil, at about 30% or 35% cheaper than the oil coming out of other regions. So we think that that's enough to encourage some of these markets to keep this oil flowing. So for now, we're not expecting a massive supply shortage, and we think prices will normalize once the panic buying calms down. Just in terms of who's most sensitive to what we believe is temporary higher oil prices, what I've done is I've said if we have oil at $100 a barrel, I can figure out how much oil these countries, various countries generally import, and figure out what proportion of their economic output they spend on oil at $100 oil price. And countries like the US that produce their own oil, it's not a particular meaningful hit for them, about 4.4% of GDP spent on oil, and that's about 0.3 at a $60 oil price. So it's like very small in their lives. Europe doesn't really produce any of its own oil, so it has quite a big reliance on oil, and it would spend about 2.5% of its economic output on buying oil imports at $100 oil. But then right at the bottom of the table, South Africa and India, these are EMs. EMs tend to be much more reliant on energy to produce economic output, so much lower services and much higher manufacturing and mining and these types of things. And so countries like South Africa and India are hurting at this high oil price. We're the ones that are kind of feeling most of the pain here. So yeah, not great for oil importing emerging markets like India and South Africa with these higher oil prices. Moving back to Europe, so oil is obviously not the only thing that we use to generate energy. And what I've got here is Europe. Europe has this was their energy mix in 2019, hasn't changed dramatically since then. But what it is solid fuels, which is essentially coal, makes up about 13% of Europe's energy needs. Petroleum products, that's essentially oil, 36%, natural gas, another 22%. Then you've got nuclear at 13%, and renewables, predominantly solar and wind, at about 16% of energy production. Now, so we're talking about 70% of Europe's energy needs coming from fossil fuels, and more importantly for this discussion, a significant portion of those fossil fuels come out of Russia. Half of the coal, 40% of the natural gas, about a quarter of the oil for Europe's energy needs comes out of those countries. So if you do the math on those numbers, you get about 25% of Europe's energy needs being provided for by Russia. Which is obviously fairly problematic at the moment, and they're scrambling to try and wean themselves off Russian oil. But this is not going to happen easily, and this is also happening at a pretty awkward time. So you've had a really unusual weather patterns over the last couple of seasons where you haven't had a whole lot of wind, you haven't had a whole lot of sun, and so the renewables have underwhelmed in terms of the production that they're delivering. And it's also been really cold, so people have needed more energy for heating. And so Europe are sort of walking this tightrope between wanting to condemn what's happening in the Ukraine, and particularly because it's happening right on their doorstep, but also being careful not to shoot themselves in the foot by losing potentially 25% of their energy supply and exposing their populace to potentially living without heating or having to shut down serious industrial capacity and losing a lot of economic output. So they're walking a pretty fine tightrope at the moment because of this energy supply. So this is another region where Europe or Russia is punching above its sort of economic weight in terms of the ripple effect that we're seeing into the rest of the world. The other one that's pretty significant is food production. And here's where Ukraine also steps into the mix. So what I've got here is a chart with various agricultural commodities, and the blue bars are what Russia exports, what's Russia's proportion of global exports, and the sort of brownish bar at the top there is Ukraine's contribution to global exports. So for barley, about 30% of global barley exports come out of this region, Russia and Ukraine. Wheat's about a quarter of the global exports, sunflower oil similar, corn right around 15%, most of it coming out of Ukraine. And then on the right-hand side, obviously fertilizer, which is not something that we eat, obviously, but that has a significant impact on agricultural yields. And so what happens now is we've had, this region is producing a lot of food for export into the export chain. We've just come through a period where we've had 2 years of very unusual weather patterns, predominantly La Nina, which means that we have drought conditions in the northern hemisphere where a lot of the agricultural commodities get produced, and then you have excessive rainy conditions in the southern hemisphere. And so what that's meant is for the last 2 years, we've had pretty low yields in the northern hemisphere, and we've had too much rain in South America, so almost no yields there. And South Africa, frankly, is only one of very few places that has benefited significantly from these weather patterns. So our rainfall has been perfect. We've got really good yields, but most of the rest of the agricultural producing regions have either been too dry or too wet. And so you've had fairly low yields globally for the last couple of years. And the fact that a lot of the ammonia and phosphates that are used in fertilizers coming out of Russia, that could add to challenges for global crop yields going forward. So that's kind of why I put that one on there. But for global food production perspective, this region's pretty important. And what I've got here is an index that's produced by the UN, which is basically a basket of essential foods, and it tracks the price of those over time. And what's happened, obviously recently, so I talked about these weather patterns that have been bad for yields. This chart goes up to before the crisis, so we haven't seen their latest levels for this chart, but even going into this crisis, we had pretty elevated food prices as a result of these unusual weather patterns. And now we're going to potentially exacerbate those by putting this conflict impact on top of that. And we risk real escalation in food price. And while for large parts of the developed world, the sort of proportion of their disposable income that they spend on food is fairly low, in emerging markets and in areas where you have people that are economically vulnerable, this is absolutely disastrous. And case in point, if you look at this chart, it spiked quite a lot around the global financial crisis. Then again into 2010, it had a fairly extended spike that stuck around for a while. And this period here coincided with the Arab Spring. So you actually had people living in economically challenging environments, which were now had really high food prices thrust on them, and it created all of this social upheaval. And so, we've already had, as I say, a pretty big spike in food prices. We now potentially risk adding on top of that the impact from this Ukraine conflict. And this has a very real prospect of creating social upheaval and economic challenges associated with that if nothing's done about that. Now, we're hopeful that after 2 consecutive La Nina seasons, that we won't get a third. It would be highly unusual. So the chances are that the weather patterns will reverse, and that will be conducive to higher yields in most of the producing areas. We're also hopeful that the majority of the food output will find its way out of Russia and Ukraine, as it largely is at this stage. But this is obviously an area to focus on, particularly for the most vulnerable and the potential implications for social upheaval. The last sort of commodity group I want to focus on, this, it's obviously a pretty somber presentation so far, but the one potential silver lining for South Africa is the PGM, the platinum group metals that we mine. And so there's 3 platinum group metals that all get pulled out of the earth together: that platinum, palladium, and rhodium. And they're predominantly used in the manufacture of vehicles to reduce emissions. So you put them in catalytic converters in order to reduce the amount of pollution that petrol and diesel engines spew out. Platinum at this stage is used predominantly for diesel engines, and palladium predominantly for petrol engines. And Russia and South Africa produce the majority of this. So platinum, we in South Africa produce 70% of it. Russia produce a decent amount, and then palladium, Russia and ourselves produce about 40% each of this commodity. And obviously, in the wake of the diesel scandal over the last few years, the shift has been much more towards petrol combustion engines, and so palladium's been pretty important. And Russia are a significant producer of palladium. And so along with that other panic buying of commodities related to the conflict, palladium's been one of the areas where we've seen prices spike. And this is pretty good for South Africa. It's a source of major export revenue for us, and higher prices are great for South Africa. Then kind of taking a step back from the commodities and looking just more broadly for investors. What does this mean for your average investor's global equity exposure? Well, I thought I'd start off with this slide, which is a table that lists a bunch of geopolitical conflicts that we've seen over the course of the last 60 odd years. And then it looks at the S&P 500 returns over various points from that crisis. And the reason we look at the S&P 500 is because it's basically a proxy for global economic activity. S&P 500 companies listed in the US are sort of large global multinational corporates, which are very sensitive to global economic growth. And so to the extent that these conflicts have a very broad global economic impact, they're likely to have a big impact on corporate earnings and by extension to the share prices. And I'm going to focus on the two right-hand columns on this slide. So the very far right-hand column is the maximum drawdown. So from the start of the conflict, how far was the worst drawdown? What was the worst drawdown that we saw for the S&P 500? And you'll see some pretty big numbers in there. You know, you got 40s, 15s, 27, 14. There's some big numbers in here. So at peak pessimism, investors were extrapolating a pretty dire outcome for the global earnings of some of these major corporates. And then the next one to the left of that, 1 month out from the start of that conflict, you struggle to find another number above 10%. The only one that sticks out there is September 11, and that was obviously had a disproportionate impact on the US. And but more broadly speaking, the initial reaction is kind of similar to that rush out and buy toilet paper moment. You kind of panic that this is going to be disastrous for the global economy. And as we get more and more certainty about the knock-on effect or the materiality of where the conflict is happening, we can make more rational decisions about how broadly this is going to affect global economic activity. And usually these small regional conflicts are disastrous for humanitarian reasons, but not particularly disastrous for a broader, from a broader global economic perspective. And if we look at how asset prices have responded, kind of plays out on this. So I've just listed the commodity price movements over the course of the pandemic, and you've seen nothing particularly material. And in fact, Brazil and South Africa topped that list. The currencies are up 4% for us and 8% for Brazil. We're actually, you know, the saying I think goes that in the land of the blind, the one-eyed man is king. So as emerging markets now, we're looking pretty healthy. We're not China that's potentially going to side with Russia and start a third world war or some sort of cold war. We don't have any conflict. Our terms of trade are looking pretty healthy based on higher commodity prices. Similar story for Brazil. So we're actually sort of economically potentially slightly better off as a result of this stuff. Some of the economies like Turkey, which is a lot of the exports from Russia and Ukraine go into Turkey, more impacted. But the biggest impact is seen in the ruble, which is down almost 20% over the course of the last month or so. And that's because investors have probably correctly decided that the most significant economic impact is going to be felt in Russia, and the rest of the world will be largely spared from too much contagion. And it's a similar story in equity markets. In fact, developed equity markets are actually up about 2.5% over the course of the last month. I think this table was prepared a day or two ago, but I don't think much has changed from there. And so developed markets have kind of looked at this. They were down a little bit in the beginning of the conflict, but much like that table I showed earlier, once you kind of digested the materiality of the broader global economic impact, you say, it's not going to be disastrous, and we can kind of move on from a financial perspective, at least. Towards the bottom of this developed market table, you can obviously see the European indices are the ones that are most impacted, and that's fairly obvious. They're right on the doorstep of this conflict. We talked about the potential energy impact and how that might impact industrial production for them. Certainly increases uncertainty about what's happening on their doorstep, and increases the reluctance of new economic projects and the like. So it is more likely to influence Europe than the rest of the world, but broadly speaking, investors have sort of shaken this one off. Emerging markets in the bottom of the table, probably obviously significantly more impacted. But again, that's largely focused on Russia and China. China, because we're not sure if they're going to kind of take the same path and then experience sanctions and all the implications that will have for investments directly into China. Particularly for foreigners. Russia, I've got it down 100% there. That's the MSCI Russia index. That's an index of Russian stocks listed outside of Russia, so predominantly in the UK and the US. And all of those shares have been marked to zero and are trading and are suspended. You can't actually trade that at the moment. So I don't think that down 100% is a true reflection of what Russian share prices are. In fact, if you look at a Russian company like Magnit, which is a supermarket chain there, in the last week or so, the local listing of the Magnit share has started limited amount of trading again. And that's pricing in dollar terms down about 30% from where it was pre-crisis, which is still a material move, but not the 100% that we're seeing on the suspended Russian foreign listed shares. But so between Russia and China, they've hurt performance of emerging markets. But ourselves and Brazil, our stock market's actually been doing pretty well over this period. Just in terms of, again, taking a step back and looking at the oil price movements and their broader impact for global economic output, I thought this chart was pretty interesting. And it goes back, there's two bars in for each country here, and it's the energy intensity of their economic output. And it's comparing 1973 to today. And what happened in 1973 and in the 70s and a couple of times in the 70s, actually, there were various massive disruptions to oil embargoes and the like. And they had a huge implication. It kicked the global economy into recession almost every time. But what's happened over the course of the last 50 odd years since then is the developed markets have become much less reliant on energy for economic activity. And so we've moved to a much more service-orientated, consumption-orientated economic model. And so, while significant is not disastrously, was not crucial for economic output. And you can see something like China. I mean, the scale exajoules per GDP output doesn't make a hell of a lot of sense, but it's just a relative move. So China, compared to the 70s, is about a quarter of as reliant on oil for GDP output. US similarly about a third of the level. Most of these developed markets are about less than half as reliant on energy as they were 50 years ago for economic output. The exceptions are obviously the emerging markets. India is still just about as reliant on oil for economic output as it was 50 years ago. And Brazil's even more reliant on that. South Africa's sort of probably not quite as bad as those two, but somewhere along those lines. But in general terms, if we see a $10 increase in the price of oil, it knocks about 0.25% off economic output globally. So it's not disastrous at all what's going on in oil. And then just to kind of wrap it up here, I'll finish off with a couple of slides on inflation and interest rates, which is where we were all sort of laser focused going into this conflict. That's what investors globally were most concerned about. And I just want to kind of take a step forward and see, has this conflict changed anything from that perspective? So what I've got here is a chart going back about 10 years for US inflation. And I'm going to focus on the US because the dollar is kind of the global reserve currency, and what happens with the US central bank and the dollar has the most significant implications for investors globally. And so looking at US inflation as a kind of as a window into potentially what might happen for monetary policy globally. The US for 8 or 10 years going into the pandemic was experiencing somewhere around 2% inflation, and most of that inflation was coming through from services, which is about 2/3 of what Americans spend their disposable income on. There was a little bit of food price inflation coming through, particularly in the last couple of years when we've had these nasty weather patterns. And then energy sort of added and subtracted as it bounced around, as it typically does. Goods prices, which you can almost barely see here, have been predominantly deflationary. So most of the time we're getting so good at manufacturing these things that they become cheaper and cheaper. So goods have been deflationary. Services, basically the only source of inflation for the majority of the last couple of decades. And then come the pandemic in the beginning of 2020, we see a couple of things happening. We see energy prices absolutely crater as all of us were locked inside. The prospects of flight and travel and those uses of energy basically disappeared overnight. And the price of oil, some of you will remember, the oil futures actually went negative at some point. You couldn't sell oil at that stage. So that became a huge deflationary source for the first sort of 6 to 9 months of that pandemic. And then as Pfizer announced the vaccine and the prospect of all of us, moving around again and becoming seeing some form of economic normalization, energy prices started to recover off that low base that became inflationary. And then we saw this huge surge in people whose disposable income, particularly in the US, hadn't really been affected. In fact, it had actually been boosted by fiscal stimulus, now wanting to suddenly buy things with all these excess savings, and manufacturing was struggling to keep up. So goods price inflation was a major source of excess inflation that we've been seeing over the course of the last year. So that's probably the most worrying. Energy is added to that. I think what happens now with the conflict is it gets worse. But usually central banks will look through food and energy inflation, which are the most likely sources of inflation from this crisis, because those things tend to normalize through time and revert to their sort of cost of production, and then they'll obviously become deflationary again. So usually central banks are willing to look through this stuff, but it'll get uncomfortable for a while. And the trouble with inflation is it has a very psychological component. So if people believe that inflation is going to be high, they almost reinforce that belief by sort of preempting things, by putting up the prices of the goods they're selling, or embedding high escalation numbers into rental contracts and the like. So we're very worried about inflation psychology becoming embedded and that creating structural inflation. But we think that most of the Ukrainian and Russian conflict sources of inflation will be ignored by central banks going forward. That being said, my last slide before I wrap it up here is on what we expect the central banks to do over the course of 2022. And so what we've got on this chart here is an extrapolation from some financial derivatives of what investors were pricing in terms of how the US central bank was going to act during the course of 2022. So going back to sort of the second half of 2021, investors were thinking that the Fed was going to have to hike once, maybe twice at 25 basis points during the course of 2022. And then as October and the third quarter came around and inflation started to spike towards those, levels we hadn't seen in the US for 40 years, people started to worry that this thing's not going to be that transitory anymore, and the central bank's actually going to have to step up and pull some liquidity out of the system. And we've got to the extent here where, this is pre-crisis, pre-conflict. We are thinking the Fed was going to have to hike 6 times at least in 2022. When the conflict happened, we worried that they might have to take their foot off the brakes a little bit because the economic impact would be broad. But once we realized that wasn't the case, and in fact, we were going to add an inflationary impulse, expectations have now shifted fairly dramatically. So we now think, or investors in aggregate now think, that the US central bank will have to hike about 8 or 9 times during the course of 2022, or 8 or 9 25 basis point, quarter percent hikes, which will take rates to the end of 2022 in this blue line to about 2.5% from basically zero at the beginning of the year. Now we have 8 central bank meetings in a year. One happened in January, no hikes there. The second one happened earlier this month, and we saw a 25 basis point hike. So to get to 2.5%, the Fed has 6 meetings left, and it's going to have to hike 2.25%. So essentially, we're saying they're hiking in every single meeting, and in some meetings, they're going to have to go at 0.5%. So certainly, this is probably more of a concern than the conflict in Russia. The conflict's having some sort of knock-on impacts, mostly through commodity prices, but this is the thing that we're probably more worried about. And that's where I'm going to leave it for now. I think, Dale, do we open up for questions?
Yes, we do. Thank you, Pete. That was wonderful. Pete, if I can ask you to stop sharing your slides. If I can ask everybody, please, to post your questions in the Q&A, and let me kick off with some questions. Pete, first question: 40% of palladium comes from Russia, but the price is down 4% since the 20th of Feb. Why, and what is your view on platinum shares?
Okay, so 40% of palladium comes from Russia. So I mean, as I said, we're still getting commodities out of Russia. The palladium is actually probably one of the easiest to get out of there, because unlike oil and gas, or oil, which requires ships, and gas, which requires pipelines and things, palladium is a precious metal. You put it in a helicopter and you move it out the country. So it's very easy to move fairly large value quantities of palladium, platinum out of the country. So supply hasn't been disrupted as much as we thought it was. Again, I said that the usage of this thing is mostly in the auto industry, and largely as a result of chip shortages, the auto industry is operating pretty much below capacity. So the demand from the auto industry for these components is probably not quite where it should be. I think in 2018, we peaked at about 90 million passenger vehicles produced in a year. In 2019, it was down in the sort of early 80s, 80 million, and we're now operating at about 65 million. So the actual demand for those metals from the auto sector hasn't recovered as quickly as possible. And I think we've taken a look and seen that the supply is not going to be as disrupted as we thought it was going to be.
Thank you, Pete. So it seems like EM and resources are going to be the winners going forward. Are you currently overweight on these?
Yeah, that's a good question. So as a house, that's kind of not necessarily right in our sweet spot. We prefer companies that are able to sort of structurally grow earnings with low cost of capital and high returns on equity, which doesn't really describe your average resource company. That said, we think they're in a pretty good position at this stage. And so I wouldn't say we're overweight resource companies just because, the South African benchmark has a lot of commodity shares in it, and we're never going to be comfortable owning that many of them. But certainly from a house perspective, I say we probably own more commodity shares than we would typically do.
Pete, in the second part of the question, on being overweight EM.
So EM is very bifurcated at the moment. As I said, Russia you can't invest into even if you wanted to. China has had all sorts of challenges, initially related to common prosperity and how they were kind of shifting their economy and spats with the US and all sorts of things going on there. So that's been pretty out of favor. And that's a big chunk of emerging markets equity exposure. That's probably almost, 60% of EM exposure, which means the 40% that's left is looking pretty exciting. And so EM, we think, it looks pretty interesting at the moment. And certainly in South Africa, we're a big beneficiary of being kind of one of the one-eyed man in that land of the blind at the moment. So I think pretty good.
What impact will rate hikes have on the currency in relation to the dollar? I assume that they're asking about the rand.
Yeah, so generally rate hikes would not be good for emerging markets. And that's just based on this kind of broad assumption that tightening monetary conditions generally pull investors towards more secure investments. And if you think of EM as being kind of high up on the risk spectrum, investors, as the Fed starts tightening, the Fed tightening almost always ends in tears at some point. So they say, economies never die. The Fed always kills them. So once the Fed starts tightening, it just feels like it's a matter of time before you have sort of economic recession. Usually that can last years, so we're not worried about that happening imminently. But once the Fed starts hiking, you think that kind of most of the punch has been drunk and people start moving capital back towards DMs. So usually a Fed hiking would be bad for the rand. I think the fact that our yields are so attractive at the moment, and actually our positioning is, I think we're one of the few economies where actually the South African government debt is in better shape than it was pre-crisis. Our GDP ratios have actually come down. So I think there's a lot of fundamental sort of tailwinds for the rand, which are preventing it from selling off like it would normally do in a tightening cycle. So I think we're sort of neutral on the movements for rand for now.
Peter, question which I assume has to do with Russia's removal from the SWIFT banking system. To what extent will Bitcoin come into the equation?
Yeah, so I think at a sort of retail level, potentially people are trying to use Bitcoin to maybe get their personal wealth out of the country. But frankly, the SWIFT system is more for corporate usage. So it's the way that, for example, a German company would pay a Russian company for the gas that they're buying, and how you would settle bond payments on companies and things like that. So I think, I think SWIFT payments is mostly related to corporate stuff. I'm not sure that corporates are quite yet at the space where they're outside of maybe Elon Musk and Tesla. I don't know of any corporates that are willing to accept payment for goods and services in Bitcoin. So I don't think SWIFT and Bitcoin is necessarily sort of a good matchup.
With the price of barrels over 100, how long will SA be able to keep up with the increases before the economy will collapse?
Yeah, that's a good question. So the longer it lasts, the more painful it is. But remember, we're getting some offsetting at the moment. So to the extent that oil is above 100, you got to assume that means there's still disrupted demand, disrupted production and supply coming out of that Russia-Ukraine area. And as long as that's happening, the price of other commodities are going to be elevated. So we're exporting stuff at elevated prices and we're importing stuff at elevated prices. So as a country, I think it's not disastrous to have oil above 100. For some consumers, it's going to be particularly painful. So the lower down the spectrum you are, the bigger the impact of high oil prices has on your commuting, on the cost of transporting your food and things. So it's not great from a social perspective, but I think from the SA fiscus perspective, it's not necessarily disastrous.
Do you anticipate Russia defaulting on debt repayment? And if so, how will this affect the markets?
Yeah, so we're watching that very closely. I think what's pretty interesting is that so it's, I would say, reasonably unlikely to default on its domestic debt payments because it can just print rubles and pay its own debt with that. What everyone's focused on is how it pays its dollar debt. And going into this crisis, if you looked at Russian debt, they had about 680 billion of foreign reserves. And so you thought, even if this crisis happened, they had more than enough firepower to be able to settle their foreign dollar-denominated debt. But of course, sanctions completely buckled that whole assumption. So now Russia can't access its dollars to pay the debt. It's been cut out of the SWIFT system, which is how you would settle those debt payments. But so far, we've had a couple of dollar-denominated coupon payments that Russia's needed to make since sanctions, and it's actually made most of those. And there's a big, on the 4th of April, one of their dollar bonds is maturing. There's about a $2 billion payment that needs to be made for that. And they've actually instructed that payment to go ahead. And the banks seem to be facilitating that. So there's certainly a willingness from, so you would say they have the resources, provided they don't all get confiscated and they never get their foreign currency back. They have the resources to pay the debt, and it seems like they have the will to pay the debt. Now, it's just a question of whether sanctions prevent them from doing that and create a technical default. And then what are the implications more broadly if they do default? It's never great, but they're a significantly smaller part of the global bond market than they were in 1998 when they last defaulted. So it'll cause pain in some corners of the market, but won't be systemically disastrous.
Is it still a risk-on environment from an equity allocation perspective, specifically tech and growth? Or should investors be looking to take risk off and look for yield income with increasing rates?
So I would say for the next 3 to 6 months, it's going to be an uncomfortable period. I think we're going to have inflation that's going to keep coming in at uncomfortably high levels in the US and developed markets. And what that means is that there'll be extreme pressure on the central banks to respond to that with tightening monetary policy, higher rates, less shrinking balance sheets. And so all of that stuff generally a pretty big headwind to risk assets. And so I would say it's kind of you've got a 3 to 6 month horizon where we probably experienced some pretty elevated volatility at the very least. And then our base case is that those inflationary impulses start fading very quickly after that, as you have base effects kicking in, as you have supply chains normalizing, as you have commodity prices normalizing. All of those things will become hugely deflationary. And so our base case is that sort of 6+ months on, the environment becomes particularly a whole lot easier. But as I say, for the next 3 to 6 months, it's going to probably feel a little uncomfortable.
What is your view on the inverted yield curve in the US as early warning signs for a possible stock market correction or pullback?
So the inverted yield curve, where the US short-term rates are higher than the US long-term rates, has generally historically been a pretty good early warning system for recessions. It's not perfect by any stretch of the imagination, and I think what it basically means is the short-term interest rates in the US are most sensitive what central banks are going to do. So people sort of forecasting how many hikes the central banks have, that's going to impact the short end of the rate. The long part of the curve is most sensitive to growth. And so what we're saying now with an inverted yield curve is the central bank's going to hike us to a point that pushes us into recession. And so you've got this inverted yield curve. My sense is that the front end is overreacted. And so I think the front end is pricing, as I showed on that slide, you're getting to sort of 2.5% by the end of this year in the US. And then actually markets are extrapolating that gets to 3% by the end of 2023. My sense, as I say, is that this inflationary pressure will decrease fairly dramatically in the first half of next year, and the need for the Fed to hike as aggressively next year is probably not going to be there, at which point we'll see the front end of the curve come down and you'll have some sort of normalization. So base case, we'll have a recession at some point, but my base case is this signal of inverted yield curve is probably not... I think it probably corrects itself over the course of the next 3 to 6 months.
The final question for today. Is stagflation a possible outcome of the conflict? And increased interest rates, high world debt? If yes, how do you protect portfolios against this risk?
Yeah, so everything's a possibility. It's certainly stagflation, not a high probability from my perspective, just because in developed markets, consumption is the main driver of economic activity, and U.S. consumers, and U.S. is the main driver of developed markets. U.S. consumers are in phenomenal shape. They've almost never been less levered. They have significant amount of excess savings. We think they saved about $2.5 trillion over and above what they normally save over the course of the last 2 years. So there's lots of dry powder. Employment is pretty good. And so while that consumer's in pretty good shape, it's very hard for you to not have economic growth. Now, what would need to happen for stagflation to kick in is, the Fed would have to kind of tighten to such an extent that they cause some severe economic damage. And while we think that they can make policy mistakes, we don't think they're going to completely implode things. And so my base case would be not great. But in stagflationary environment, you basically want to be investing in companies that don't require economic growth to grow their top line. So these are companies that are either gaining market share or they're innovating and getting sales from new areas. And you want companies that have strong pricing power. So typically those are things in sort of, luxury or areas where consumers are less impacted by economic movements.
Pete, thank you so much for your time today. It was wonderful. It was insightful. We had a wonderful attendance today. As per always, we will get the CPD certificates out to you as soon as we possibly can. And I look forward to seeing all of you at the next Essentials. Bye-bye.